Jobs are strong and unemployment's falling. Will that be bad for the stock market? The infamous jobs report came out strong yesterday, with U.S. payrolls rising 199,000 in November versus an expectation of 190,000. And the unemployment rate declined to 3.7% versus a forecast of 3.9%. So what did the bond and equity markets do? Well, initially they both sold off sharply, but equities immediately came roaring back to finish the day up, while bonds moderated their losses to finish the day down, but not at the extreme. Why do market participants, and notice I didn't call them investors, react so quickly and with so little thought? Are a hot jobs market and increasing wages bad for the economy and for corporate earnings? Well, it depends. Increasing demand and hiring of labor and increasing wages alone would be inflationary. But there's another component that wasn't even reported in that CNBC article and broadcast, and that is productivity. If labor demand is strong and wages go up, but productivity goes up as well, then corporations are getting more efficiency out of their people, and they don't need to pass along the higher wages in their prices. Just take a look at the unit labor costs for the third quarter from the Bureau of Labor Statistics. Non-farm business and business are all lower than a year ago, while manufacturing is higher than a year ago. But it's also very important to look at the revisions for the second quarter Bureau of Labor Statistics productivity numbers. Notice the unit labor costs have all been revised lower across the board. Here's what Cathie Wood had to say.
The last few months have been quite rewarding in the financial markets, and we think there is good reason for that. If we look at the economic data, both in real terms and the inflation data, we're seeing a weakening in the economy, much weaker inflation, both lower than expected, and the Fed is beginning to change its tune.
Before we get into the metrics and what they have to say about the current state of the markets, in my video last week regarding equities, I said, well, now where are we? Well, now this is heading higher, but the confidence level has been kind of waffling down here at a lower level, but you can see it's also pointing higher now. This tells me we're likely to go higher next week, and you'll see this in the other indicators as well as we go through these metrics. I put a link to that video in the pinned comments below. And if we look at what happened to equities this week, it's clear the major indices all finished the week higher. Although I have to be honest, the market action on Monday back here, and then again on Thursday, made me start to question that prediction. I've been right, I think, almost 100% of the time, but eventually I'm going to get it wrong. And how do things look over the past month? Well, if we look back over the past month, you can see there's a very healthy risk appetite here, with ARK Invest up the most, small caps up second, the Dow up third, S&P fourth, and the NASDAQ 100 has been taking a little bit of a breather as we discussed last week. What about year to date? Year to date, this looks extremely healthy. ARK Invest up the most, NASDAQ second, S&P third. Now the Dow's edging out small caps, but small caps are right behind it, just right behind. So this looks very, very good.
I'm afraid to say how I feel.
And what about the bottom dynamics? Well, if we look at the bottom dynamics, you can see we had a bottom forming confirmation back here. This blue line is a bottom confirmation. And you can see that the confidence level was very, very high. Since then, this bottom confirmation has been up here at or near 100%, but you can see that the confidence level fell way off. Now, last week when we were right here, the confidence was rising, the bottom confirmation signal was rising, the price was going up, and I said, as I mentioned earlier, I thought the markets were going to go higher. Well, they did, in fact, end up just a little bit higher, but where are we now? Well, right now where we are is the bottom confirmation is falling. Confidence is falling a lot. I would say we're going to go higher next week, and you'll see that plays out in the metrics we're going to look at in the next slide. So let's take a look at risk versus opportunity. Well, if we take a look at risk versus opportunity, you can see this is crazy. Risk acceleration is down here at 20. This is zero cause for concern. And you can see, as I mentioned, that risk, I talked about risk back here, I said that's going to start dropping. It's going to follow risk acceleration, but it's a much slower indicator, as you can see. Now it's below 80 and going lower, so this looks great. And opportunity level is up here at a very high level. It's above the mid 70s. These numbers look really, really good going forward. And we've got a rising market here when we look at the price of the S&P 500.
Don't wanna let you down.
And how does this all show up in equity versus safety? Well, if we look at equity versus safety, we still have a very healthy looking risk appetite here for equities and a risk appetite for long treasury bonds. So if we take a look at the NASDAQ 100, though, you can see it peaked out here at first place, dropped off to third, and now is way down here at seventh. Now, this could give you some cause for concern to say, well, hey, Calvin, it looks like people are running away from risk, but not really. If we take a look at cash, we take a look at safety, safety hasn't budged. It's down here in ninth place. And if we look at small caps, also a high risk asset, you can see that small caps moved up into second and have stayed there very nicely. Now, I'm not going to draw lines for the Dow and the S&P, but you can see they also moved up the rankings in the past week. So I think there's still a very, very healthy risk appetite here, along with a very healthy treasury risk appetite for long duration bonds. And if we look at just the safe haven assets, cash, short duration treasuries, and intermediate treasuries, you can see they're all down here at the bottom. This is great from an equity risk perspective. And if we look at the long bonds, there is also a risk appetite for long duration bonds, which were just absolutely beat up in the past. And we'll take a look at that when we look at treasuries. How does all of this show up in the buying and selling pressure? Well, I like what I see here. You can see that the Dow, the buying pressure in the Dow, this gray line, has fallen off here, even while the price continued higher. The S&P 500, similar picture. The buying pressure has been falling, even though it went up a little bit over the last couple of days, while the index price has been moving higher. What about the NASDAQ 100? Well, as I said, the NASDAQ has been taking a breather. You can see it went sideways, pulled back, and then recently started to go up again. And you can see that the buying pressure, which was below the selling pressure here, has started to move higher. So hopefully this trend will continue. And what about ARK Invest? Well, ARK Invest has just been stellar. Look at this. The buying pressure well above the selling pressure down here, and the price moving higher pretty consistently. And what if we take a look at small caps? Well, small caps, we've had a very kind of a choppy rally here with a pause and then a continuation higher. And you can see that in the buying and selling pressure. But ultimately, the buying pressure is above the selling pressure here. And this looks good going forward. So really good risk appetite here, which is another reason I'm saying I think things are going to go higher next week. And what about sector rankings? Well, remember, these sector rankings tend to move fairly slowly. They take a longer view. They tend to move kind of slowly. And you can see, though, even last week, even though they move slowly, we had Bitcoin in first place, technology. We had the NASDAQ 100 here. And now cash was still up here, but semiconductors were here. And innovation, ARK Innovation, was down here. And you can see the consumer discretionary was down here below consumer staples. And treasuries, you had long bonds way down here. Now, if we go to this week, treasuries have moved up a notch. So there's a little bit more of an interest in riskier bonds, and we saw that earlier. And you can see that consumer discretionary moved from here up to here, while consumer staples moved down to here. And cash has moved from here all the way down to here. And we still have Bitcoin, technology. The NASDAQ 100 has moved down a notch because it's kind of taking a pause here. But ARK Innovation has moved from the middle of the pack into this upper quadrant up here. Let's call it that. So this is looking very, very healthy. Now let's take a look at sector rank acceleration, because these kind of give you more of a current indication where things are. And you can see that last week we had semiconductors up here, ARK Innovation way up here, consumer discretionary up here, cash way down there. Well, where are we this week? This week we're even in a better place. You can see cash has moved all the way down here to last place. Long bonds, long treasuries have moved from here all the way up to here, and we're seeing that in equity versus safety. You can see consumer discretionary has moved up here. And then we've got innovation and semiconductors all up here. Now, the NASDAQ 100 is pulled back, but it's sort of taking a breather again. So this looks very good. Now let's take a look at treasuries. And you can see that for the week, treasuries ended up very, very nicely, with the highest risk treasuries finishing first, 20 years second, and then the shorter duration treasuries all down here at the bottom. This is a very healthy risk appetite in the bond market. What about over the past month? Well, you can see over the past month, things are up very nicely. These are equity returns, by the way, 7.44% for a month. Those are really equity-like returns in the long bonds, which are safer. This is a great opportunity. What if we take a look at year-to-date? Well, year-to-date, you can see we had a very nice bottom here. And since that point in time, treasuries have really, really rallied higher. This is great looking. And how does all of this show up in the buying and selling pressure for treasuries? Well, if you look, these look great. I mean, you can see in the short bonds here, buying pressure went actually off the charts and is still at a very high level and moving higher. Now, I'm going to point out something that happened. I don't remember if it was last Friday or the Friday before, but you can see on all of these, the price dropped on Friday, all of them. And I think that was due to that jobs report coming in kind of hot. So investors, or they call themselves investors, decided to sell treasuries because they think the Fed's going to either hold rates high longer or even possibly increase them. Well, look what happened to the buying pressure in every single case just about. The buying pressure moved up here as the price fell. So that tells me that treasury investors were buying on the dip. Now this one for intermediates, it didn't drop. It didn't really drop. It kind of stayed flat. That's strong. And here for long intermediates, you can see the buying pressure went up as the price dropped. And for the long bond, buying pressure went up as the price dropped. So this is buying on the dips. This is really encouraging and leads me to believe that treasuries could continue moving higher in price, lower in yield next week. And how does that all show up in the yield curve? Well, remember I said the yield curve was probably going to become a bit more inverted as the long bond yields dropped, but the Fed sort of kept the shorter ones higher artificially. And you can see we're now at almost 50 basis points inverted. And that is in fact, what's happening. And you can see what the futures market thinks. There's a 97.1% chance that the Fed will leave interest rates where they are. They won't raise them. They won't lower them when they meet on December 13th. Now, what if we take a look at that Fed rate monitor? So here's the same exact thing, and you can see where it is right now. And this is the meeting next week, and we'll find out what happens on Wednesday when they meet. But let's go forward in time. So if we look at January, the blue bar is where interest rates are right now, where the Fed rates are right now. And you can see that now the futures market is starting to say, well, maybe by January, there's a small possibility they'll actually lower rates. If we go out to March, this possibility becomes even bigger. In fact, a half-point rate reduction starts to become a possibility. We go out to May, you can see that there's a very strong chance of some sort of rate reduction. Go to June, it gets stronger. Go to July, and there's like almost no chance that they're going to keep rates the same, that they'll be lower by then. So hopefully this is the way things play out, which will continue to drive those long Treasury bonds higher and create a great opportunity for fixed income investors.
Feel like I'm afraid.
And what about gold? Well, gold has kind of lost its luster here. You can see it had a very, very nice run up here, and now it's starting to falter. And you can see that in the buying pressure, which peaked out just before prices peaked, and now it's really collapsed, and the selling pressure is starting to come up. So gold does not look good going forward.
You can have
What about Bitcoin? Well, Bitcoin has been on just an absolute tear, and you can see that we had this huge spike back here in the buying pressure. It kind of bottomed out here, the buying pressure did, and now it's starting to go higher again. You can see the price is just moving up so nicely. This is great.
if it's only how.
Several weeks ago, I heard an interesting discussion about the current state of the world and the current state of the markets. I really wish I could find that clip to share it with you, but I don't remember who was talking and where I saw it. I kind of poked around but couldn't find it. But the commentary was something like this. Over the past 60 plus years, we've had very few years without wars, major social disruptions, government problems, and the like. And the markets have fared very well over those many, many decades. We've had the Vietnam War, all the social unrest that came with it. We had the 9/11 attacks, and I could go on and on about the social and geopolitical risks that have happened over the past 60 years. So why do investors think it will be different this time? Keep that in mind. As an investor, you need to take the long view and allocate according to your risk tolerance rather than fretting about what's currently happening in the world that could turn the markets upside down. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below. One is titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and the other one is titled The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water. Wet my lips but the sun is stronger. Pour it out if I'm being honest. It's just not everything you promised. Running down, drying out, what did you say? What did you say when I told you? Maybe this wrist wasn't gold proof. Packing my bags like it's all true. Hard to make friends when I'm focused on all these bars that I'm holding. I like the cold but it's lonely, yeah. This life feels like the sunny water. Wet my lips but the sun's stronger. Pour it out, if I'm being honest. It's just not everything you promised. Running down, drying out, what did you say? I'm a